Hello and welcome to our channel. Today, we're giving an introduction to stock investing in the United States. If you're not subscribed yet, don't waste any time and subscribe now so you won't miss any valuable content that we have to offer. During this video, we'll cover the basic concepts of stock investing, including how stock markets work, how to choose the right stocks, and how to start investing. Leave a comment and a like to show your support for our channel, which is growing every day thanks to you all. Let's get started. The stock market in the United States is one of the most important and advanced in the world. It is comprised of many companies from various sectors, such as technology, health, financial, and energy, selling shares to raise capital and finance growth. The stock market in the United States is governed by strict regulations and closely monitored by financial authorities, ensuring fair and transparent trading. It is also highly liquid, meaning investors can easily buy and sell shares quickly. The New York Stock Exchange, NYSE, and NASDAQ are the two largest stock exchanges in the United States. Together, they represent hundreds of companies from various sectors and sizes, with a combined market value in the trillions of dollars. Investing in stocks in the United States can be a powerful way to build wealth in the long term, especially as many of the largest and most successful companies in the world are listed on the U.S. stock market. However, it is also important to remember that stock investing is risky and can result in significant losses. That's why it's important to study, inform yourself, and invest strategically and consciously. Investing in stocks is one of the most popular and effective ways to create wealth in the long term. However, before starting to invest, it is important to have a good understanding of the subject in order to make informed and strategic decisions. Here are some reasons why it is important to know about stock investment. Understand risk. Investing in stocks can be risky and can result in significant losses. By understanding how the stock market works and the factors that can affect stock prices, you can assess the risk and make informed decisions about how to allocate your money. Create an investment strategy. Knowing about stock investment allows you to create a personalized investment strategy and adjust it over time. This includes choosing the right stocks, diversifying your portfolio, strategically allocating resources, and planning your portfolio for the long term. Achieve financial goals. Investing in stocks can be a powerful way to achieve your long-term financial goals, such as retirement, buying a house, or funding education. By knowing about stock investment, you can maximize your earning potential and achieve your financial goals more efficiently. Earn passive income. By investing in stocks, you can earn passive income through dividends or appreciate the value of your stocks over time. By knowing about stock investment, you can choose the right companies and the right time to invest, maximizing your earnings and obtaining additional passive income. In summary, knowing about stock investment is essential for making informed and strategic decisions about your money. Learning about the subject can help you achieve your financial goals, earn passive income, and maximize your long-term earnings. Stocks, also known as shares or equity, represent ownership in a company. When you buy a stock, you become a partial owner of the company and are entitled to a portion of its profits and assets. Companies issue stocks as a way to raise capital for growth and expansion. In exchange for investing in the company, stockholders have the potential to earn a profit through stock price appreciation or through dividends paid out by the company. The stock price is determined by the supply and demand in the market and can fluctuate daily based on various factors such as company performance, economic conditions, and market sentiment. Stocks are traded on stock exchanges such as the New York Stock Exchange, NYSE, or NASDAQ. Investors can buy and sell stocks through a brokerage account, either directly or through a financial advisor. Investing in stocks can be a great way to build wealth over the long term, but it also involves risk. It's important for investors to thoroughly research a company before investing and to have a well-diversified portfolio to mitigate risk. The stock market in the United States is a centralized marketplace where public companies can issue and trade stocks, which are units of ownership in the company. The market operates through a network of exchanges, such as the New York Stock Exchange, NYSE, and the NASDAQ, which facilitate the buying and selling of stocks. Investors buy stocks in companies they believe will perform well and generate returns. When a company wants to raise capital, it can issue additional shares of stock to the public, which can be purchased by individual investors or institutions. The price of a stock is determined by supply and demand in the market and can rise or fall based on various factors such as the company's financial performance, economic conditions, and investor sentiment. The stock market in the United States is regulated by the Securities and Exchange Commission, SEC, which sets standards and guidelines to protect investors and promote fair and transparent markets. Additionally, companies listed on the stock market are required to regularly report their financial performance and other relevant information to the public to ensure transparency and accountability. Individual investors can participate in the stock market through a brokerage account, which allows them to buy and sell stocks online or through a broker. It's important for individual investors to understand the risks involved in investing in stocks and to conduct thorough research before making investment decisions. The stock market can be volatile, and there's no guarantee of returns, but it remains one of the most popular investment options for those seeking to grow their wealth over the long term. There are two main types of stocks: common stock and preferred stock. Common stock is the most common type of stock and is owned by individual shareholders. It gives the owner a vote in the company's decision-making and a share in the company's profits through dividends. Common stock also gives the owner the potential for capital gains if the stock price increases over time. Preferred stock, on the other hand, typically does not give the shareholder voting rights but offers a fixed dividend that is paid out before any dividends are paid to common stockholders. Preferred stock also has priority over common stock in the event that the company liquidates or goes bankrupt. Preferred stock does not offer the same potential for capital gains as common stock, but it is generally seen as a more stable investment. In addition to these two main types of stocks, there are also different classes of stock that are issued by companies. For example, Class A and Class B shares may have different voting rights, dividend amounts, or conversion rights. It's important to understand the differences between different types of stocks and classes of stock when making investment decisions. Investing in stocks and investing in mutual funds are two different ways to invest your money. Both have their own benefits and drawbacks, and choosing between the two will depend on your investment goals and risk tolerance. Stocks are ownership shares in a publicly traded company. When you purchase a stock, you become a partial owner of that company and are entitled to a portion of its profits. The value of your stock will fluctuate based on the performance of the company and overall market conditions. Stocks are generally considered riskier than mutual funds, but they can also offer higher returns over the long term. Mutual funds, on the other hand, are a type of investment vehicle that pools money from many investors to purchase a diverse portfolio of stocks, bonds, and other securities. The goal of a mutual fund is to provide investors with exposure to a range of assets, while reducing overall risk through diversification. When you invest in a mutual fund, you are essentially buying a small piece of the fund's portfolio. The value of your investment in a mutual fund will rise or fall based on the performance of the underlying assets in the fund. In summary, investing in stocks provides direct ownership in a company and the potential for higher returns, but also carries higher risk. Investing in mutual funds provides diversification and lower risk, but generally lower returns. The best option for you will depend on your investment goals and risk tolerance. Choosing the right stocks based on fundamental analysis in the United States involves evaluating a company's financial health, growth prospects, and overall stability. Here are some key steps to consider when conducting fundamental analysis. Review financial statements. Look at the company's income statement, balance sheet, and cash flow statement to understand its revenue, expenses, debt, assets, and liquidity. Analyze earnings. Calculate key metrics such as the price-to-earnings (PE) ratio, earnings per share (EPS), and return on equity (ROE) to determine the company's profitability and efficiency. Evaluate growth prospects. Look at the company's revenue and earnings growth over time, as well as its plans for future expansion and market share. Assess management. Research the company's management team, their experience and track record, and their plans for the future. Evaluate the industry. Look at the overall health of the industry, including its size, growth prospects, and competition. Consider market trends, pay attention to current market trends and economic indicators that may affect the company's future performance. Check for red flags, look for any warning signs that may indicate financial or operational problems, such as negative cash flow, declining earnings, or legal or regulatory issues. By conducting a comprehensive analysis of these factors, you can determine whether a company is likely to be a good investment over the long term and make informed decisions about which stocks to buy or sell. Stock selection based on technical analysis in the United States involves using charts and other technical indicators to identify patterns in stock prices and trading volume. Technical analysts believe that these patterns can provide insight into future market trends and price movements. The following are some common approaches used in technical analysis. Chart patterns. Technical analysts look for patterns in stock charts such as head and shoulders, triangles, and wedges. These patterns can signal changes in the trend of a stock's price and can be used to make buy or sell decisions. Moving averages. Moving averages are used to smooth out stock prices over a set period of time, making it easier to identify trends. Technical analysts look for instances where a stock's price crosses above or below a moving average, which can indicate a change in trend. Indicators. Technical analysts also use various indicators to provide insight into a stock's price movements. Examples of commonly used indicators include the Relative Strength Index, RSI, the Moving Average Convergence Divergence, MACD, and the Bollinger Bands. Volume. Technical analysts also consider trading volume when making investment decisions. High volume can indicate a high level of interest in a stock, while low volume may suggest a lack of interest. It is important to note that technical analysis is just one approach to stock selection and that it does not guarantee success. It should be used in conjunction with other methods, such as fundamental analysis, to make informed investment decisions. Know your investor profile. Determine your risk profile and financial goals to help you choose the right stocks. Research the company. Analyze the financial situation, earnings history, and prospects of the company before investing. Follow the fundamentals. Stay updated on economic, political, and industry news related to the company you want to invest in. Diversify your portfolio. Don't invest all your money in just one company or sector. Diversify your portfolio by investing in different companies and sectors. Monitor the company's performance. Check the company's financial performance, including earnings, revenue, and cash flow. Technical analysis. Use charts and other technical tools to identify price trends and market entry and exit points. Stay focused on the long term. Remember that long-term success is more important than immediate gains. Stay patient and don't be discouraged by short-term fluctuations. Remember that choosing stocks is an important decision and should be done with care and attention. Always consult with an investment professional before making financial decisions. Starting to invest in stocks in the United States is a straightforward process, but it is important to understand the risks and responsibilities involved. Here are the steps to get started. Open a brokerage account. You will need a brokerage account to buy and sell stocks in the U.S. Choose a reputable brokerage firm and open an account online or in person. Fund your account. You will need to transfer funds from your bank account to your brokerage account in order to make stock purchases. Choose your stocks. Do your research and choose the stocks you want to buy based on your investment goals, risk tolerance, and market analysis. Place your order. Use your brokerage's trading platform to place an order to buy or sell stocks. Monitor your investments. Regularly monitor your investments and be mindful of market conditions. Make adjustments to your portfolio as necessary. Seek professional advice. Consult a financial advisor or investment professional to help you make informed decisions about your investments. It is important to remember that investing in stocks comes with risk, and past performance is no guarantee of future results. It is important to educate yourself and do your own research before making investment decisions. Risk tolerance is an individual's ability to handle variations in the value of their investments and is an important characteristic to consider when investing in stocks or other financial assets. Here are some ways to know your risk tolerance. Take an investor profile test. Many brokers offer online tests to help you determine your risk profile. These tests ask about your age, income, financial goals, and other relevant factors. Think about your financial history, reflect on your relationship with money and your financial history. For example, how have you handled variations in the value of your investments in the past? Consider your financial needs, think about your short and long-term financial needs. For example, if you are approaching retirement or need money soon, a more conservative portfolio may be best. Consider your ability to withstand losses, think about how much you are willing to lose before you start worrying about the loss. This can help you understand your risk tolerance level. Remember that your risk tolerance can change over time. It is important to regularly review your risk tolerance and adjust your investment portfolio if necessary. Having an investment strategy means having a plan in place for how to allocate your assets and make investment decisions. Here are some steps to create an investment strategy. Define your goals. What do you want to achieve through investing? Consider your long-term financial goals and risk tolerance. Determine your investment timeline. How long do you plan to hold on to your investments? This will help you determine your investment strategy and the types of investments to consider. Assess your risk tolerance. How comfortable are you with taking risks? This will help you determine your asset allocation and the types of investments that align with your risk tolerance. Diversify your portfolio, spread your investments across different asset classes such as stocks, bonds, and real estate to reduce the impact of market fluctuations on your portfolio. Consider using a professional. Consider working with a financial advisor to develop a customized investment strategy that meets your specific needs. Monitor and adjust your strategy. Regularly review your portfolio and adjust your strategy if necessary to ensure it aligns with your goals and risk tolerance. Remember, an investment strategy should be tailored to your individual needs and goals, and should be regularly reviewed and adjusted as needed. There are several ways to stay informed about investments and stock applications in the United States. Read financial news and analysis. Stay up to date on the latest financial news and trends by reading reputable sources such as Wall Street Journal, Financial Times, and Bloomberg. Follow financial experts and market analysts. Follow financial experts and market analysts on social media or sign up for their newsletters to receive their insights and opinions on current market conditions. Attend webinars and events. Participate in online webinars and attend investment events to learn from professionals and expand your knowledge on investments and the stock market. Monitor market data and performance. Keep an eye on stock market performance, stock prices, and indices through websites such as Yahoo Finance, Google Finance, and NASDAQ. Educate yourself through books and courses. Read books on investing and finance, and consider taking online courses to deepen your understanding of the stock market and investment strategies. Remember, staying informed and knowledgeable about investments is essential to making informed decisions and achieving your financial goals. Here are the key points for staying informed about investment and stock applications in the United States. Keep up with financial news, read financial news websites, and subscribe to financial news sources to stay up to date on the latest market trends and stock performance. Follow relevant organizations and experts. Follow organizations such as the Securities and Exchange Commission, SEC, and relevant financial experts on social media to receive updates and insights on the stock market. Attend events and webinars. Attend events and webinars hosted by financial institutions, stock market experts, and investment firms to learn more about investment strategies and market trends. Do your own research. Take the time to research companies and industries that you are interested in investing in. Read annual reports, analyst reports, and earnings releases to get a better understanding of a company's financial performance. Seek advice from professionals. Consider seeking advice from financial advisors or investment professionals to gain additional insights and advice on investing in the stock market. Remember to regularly review and update your investment strategy and make informed decisions based on your personal financial goals and risk tolerance. Here are some ways to find encouragement to start investing in stocks. Educate yourself. Understanding the basics of investing and the stock market can give you confidence and motivation to start investing. Surround yourself with supportive people. Seek advice from friends or family members who have experience with investing, or join investment groups or forums to connect with others who share your interest. Set achievable goals, start small and set realistic goals for yourself. As you gain experience and confidence, you can gradually increase the size of your investments. Celebrate your successes, take pride in your achievements and celebrate your wins, no matter how small they may be. This will help you stay motivated and focused on your investment strategy. Consider working with a financial advisor. A financial advisor can help you develop a personalized investment strategy and provide guidance and support to help you stay on track. Thank you for taking the time to watch the video. Your support means a lot to us. If you found the content helpful, please consider leaving a comment and giving us a like. Your feedback helps us improve and grow our channel. Your engagement is critical to our success and we appreciate your support.